Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Growth Stocks Explained: Why Tesla, Meta, and others dominate investor portfolios. Growth stocks are companies expected to grow faster than the market, attracting investors looking for bigger returns. These businesses reinvest their profits to expand, which often means they don't pay dividends. Instead, they focus on innovation, market share, and future potential. Companies like Tesla and Meta are prime examples, drawing attention for their strong growth prospects and industry leadership. If you're aiming to build wealth over time, understanding why these stocks dominate portfolios is key to making smart investment decisions. What are growth stocks? Growth stocks represent companies that prioritize expansion above all else. These businesses focus on reinvesting their profits back into operations, fueling development, innovation, and market dominance. Unlike dividend-paying companies that reward investors with immediate income, growth stocks aim to increase the value of their shares over time, offering robust potential for long-term returns. Think of companies like Tesla and Meta, which have captured investor attention by consistently delivering rapid growth and shaking up their industries. While this type of investment can be exciting, it's important to understand the characteristics and how they compare with other types of investments, like value stocks. Attributes of growth stocks. What sets growth stocks apart? There are a few defining traits that make these companies unique and attractive to certain investors. Understanding these attributes can help you identify growth stocks in the market. High earnings growth. Growth stocks are known for their rapidly growing earnings, often outpacing the broader market. These companies operate in sectors where demand is expanding quickly, like technology, renewable energy, or e-commerce. Revenue potential. It's not uncommon for growth stocks to generate exponential revenue over shorter time frames. They may launch groundbreaking products, enter new markets, or disrupt traditional industries, creating opportunities for massive revenue increases. Relentless innovation. These companies don't shy away from risks. Growth stocks frequently push boundaries, testing new ideas and technologies. For instance, Tesla's approach to electric vehicles and Meta's commitment to virtual reality demonstrate their ambition to stay ahead of the curve. Reinvestment over dividends. Instead of delivering profits to shareholders through dividends, growth stocks reinvest earnings to fund further growth. This could mean hiring top talent, ramping up production, or acquiring other businesses. These traits make growth stocks appealing to investors looking for the potential of higher returns, even if that comes with higher volatility. Growth stocks versus value stocks. When building an investment strategy, it's important to understand how growth stocks compare to value stocks. While growth stocks are typically focused on future earnings potential, value stocks represent companies that are seen as undervalued by the market. Here's a more detailed comparison: earnings versus undervaluation. Growth stocks feature soaring earnings expectations, while value stocks often have slow or stable earnings but trade below their intrinsic value. Value investors aim to find hidden gems priced lower than their worth. Risk and volatility. Growth stocks are often more volatile because their valuations rely heavily on future performance. A missed earnings report can send their prices tumbling. In contrast, value stocks are typically less risky since they already have a proven track record and sell at attractive prices. Time horizon. Growth stocks cater to long-term investors willing to ride out short-term market swings in hopes of large future gains. On the other hand, value stocks often appeal to those who prefer steady returns and lower risk over time. Industry focus. Growth stocks dominate sectors like technology and biotech, where innovation is constant. In comparison, Value stocks are more common in established industries like manufacturing, utilities, or finance, where stability is key. To put it simply, if growth stocks are the sprinters in a race for high returns, value stocks are the marathon runners, pacing for consistent, reliable gains. Both can play important roles in a well-rounded portfolio. It all depends on your risk tolerance, financial goals, and investment strategy. Why invest in growth stocks? Investing in growth stocks can feel like stepping into a high-reward opportunity. These companies are often at the forefront of innovation, building new technologies, expanding into untapped markets, and reshaping industries. But what makes them particularly compelling for investors? Let's break it down. High growth potential. Growth stocks have a reputation for delivering higher returns compared to other types of investments over the long term. Why is that? These companies focus on expanding their business aggressively, capturing market share, and generating rising revenue year after year. Unlike more conservative investments, which may focus on stability or dividends, growth stocks channel capital into research, development, and scaling. The result? If you're willing to ride out the ups and downs, you stand to benefit significantly from these companies' rapid expansion. For instance, Tesla's stock price skyrocketed over the years as it pioneered the electric vehicle market and driven demand for sustainable transportation. Similarly, Meta, formerly Facebook, saw its value soar during its early years by evolving into a dominant force in social media and digital advertising. While past performance doesn't guarantee future results, history shows that solid growth companies often outpace the market with eye-popping returns. Innovation and market leadership. Growth companies are leaders, not followers. They don't just participate in the market, they set the pace. These are the businesses driving new trends, inventing products we didn't know we needed, and capturing consumer demand before others even recognize it. Think about Tesla. They transformed what once seemed like a niche product, electric cars, into an industry standard. Along the way, they developed cutting-edge battery technology, autonomous driving software, and even energy solutions. Now, Tesla isn't just a car company, it's a global symbol of innovation. Or take Meta, which didn't stop at becoming the king of social media. They've doubled down on metaverse technologies, virtual reality, and AI to stay ahead of competitors and redefine how people connect online. Investors who backed these companies early reaped large rewards as these businesses pushed boundaries and expanded their dominance. Investing in growth stocks means aligning yourself with companies unafraid to take risks and innovate. By doing so, you'll gain exposure to some of the most exciting advancements shaping the future. Portfolio diversification. While growth stocks offer the potential for significant returns, they can also introduce higher volatility. That's where portfolio diversification comes in. By including growth stocks alongside other types of investments, you can strike a balance between risk and reward. For instance, pairing growth stocks with value stocks or dividend-paying companies can help smooth out the inevitable ups and downs of the market. Growth stocks bring the potential for capital appreciation, while other investments provide stability or consistent income. Together, they create a mix that can help you achieve your long-term financial goals. Think of your portfolio like a recipe. Growth stocks are the bold spice that makes it exciting, but they need to be balanced with other ingredients to create a well-rounded dish. By keeping a diversified mix, you're not putting all of your eggs in one basket, an important strategy in any market environment. Popular examples of growth stocks. Growth stocks often steal the spotlight because of their impressive potential to transform industries and generate substantial returns. Let's take a closer look at two prominent pioneers in the growth stock category, Tesla and Meta. These companies exemplify what it means to innovate, disrupt, and position themselves as leaders in their respective sectors. Tesla, revolutionizing the automotive industry. Tesla has redefined what it means to be an automaker. It's not just a car company, it's a technology powerhouse driving the future of renewable energy and transportation. By championing electric vehicles, EVs, when the world was still heavily reliant on gas-powered cars, Tesla proved it could disrupt one of the most established industries in existence. Impact on automotive and renewable energy. Tesla's Model S, Model 3, and subsequent EVs didn't just challenge traditional automakers. They put the entire industry on notice. These vehicles weren't only eco-friendly, but also offered groundbreaking performance, rivaling or surpassing their gas-guzzling counterparts. From ludicrous acceleration speeds to advanced autonomous driving features, Tesla has consistently set new benchmarks for what cars can do. Beyond its cars, Tesla has pushed boundaries in renewable energy. The company's solar products and energy storage systems, like the Powerwall, have made sustainable energy more accessible to consumers and businesses alike. Tesla is no longer just a car manufacturer, it's an integral player in the global shift toward sustainability, financial performance, and growth. Tesla's growth trajectory is jaw-dropping. The company transitioned from years of major cash burn to becoming highly profitable. Between 2020 and 2023, Tesla's annual revenue more than tripled, fueled by increasing EV sales and global expansion into key markets like China and Europe. Its stock price, while notoriously volatile, has rewarded long-term investors spectacularly. Early Tesla shareholders saw their investments multiply exponentially as the company solidified its position as a leader not just in EVs, but in innovation as a whole. Tesla's ability to scale, innovate, and expand new product lines continues to make it one of the most closely watched growth stocks in the market. Meta, transforming social media and the metaverse. Meta, the company formerly known as Facebook, isn't just one of the largest social media platforms. It's a technology giant reshaping how we interact in the digital world. With billions of active users across its platforms like Facebook, Instagram, and WhatsApp, Meta has cemented its role as a cornerstone of the social media economy. That's it for Part 1. Stay tuned for Part 2, where we'll explore more about the strategies behind investing in growth stocks and how to spot future winners. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.